Have you ever wished for just one single number that could tell you if the stock market is, dangerously expensive or maybe attractively cheap? Well, it turns out one of the world's greatest investors thinks he found one. Today, we are breaking down the Buffett Indicator. And we're diving in right now because as of today, January 19th, 2026, this powerful metric is sitting at an incredible 230%. Now, to be clear, that is the highest level in its entire recorded history. We're talking higher than the dot-com bubble, higher than the 2021 peak. Just wow. And just to put that 230% number into perspective for you, here's a quote from the man himself, Warren Buffett, all the way back in 2001. He said, "When this ratio approaches 200%, you are playing with fire." So what does it mean when we've blown way past that number? Right. So the market is officially playing with fire. Let's get into what that really means for all of us, for our investments, and, well, for the economy as a whole. But before we get ahead of ourselves, what exactly is this indicator? I mean, how can one simple number possibly act as a thermometer for the entire stock market? Well, at its core, the idea is actually pretty simple. The indicator takes the total price tag of the entire US stock market, yep, that's every publicly traded stock combined, and it just compares it to the country's total economic output, its gross domestic product, or GDP. In other words, you can think of it as a big reality check. It asks a really fundamental question. Is the valuation of corporate America getting way, way ahead of the actual business being done in America? Is the story outpacing the reality? And Buffett even gave us a simple guide. He said, look, if this ratio drops down into the 70 to 80% range, it's a huge signal that stocks are probably cheap, and it's a great time to be a buyer. But once you start getting over 100%, it suggests the market is getting a little frothy, maybe a bit overvalued. So we know what it is, we know the theory, but does it actually work? Let's take a look back at how this indicator has performed at some major turning points in history to see if it's really a reliable warning system. Honestly, the track record is pretty compelling. It peaked around 150% right before the dot-com bust, then cratered to nearly 60% during the absolute depths of the 2008 financial crisis, which was a generational buying opportunity. It shot past 200% during the 2021 everything bubble, and today, like we said, it's in completely uncharted territory at 230%. And this just illustrates its predictive power perfectly. When the indicator hit that low point back in October of 2008, Buffett himself famously wrote an op-ed telling America to buy stocks. And guess what? He was dead right, and anybody who listened was handsomely rewarded. So if it's this good at calling tops and bottoms, you have to ask, right? Why isn't everyone just using this to perfectly time the market and get rich? Well, like any single metric, it's not perfect. It has some pretty crucial flaws. Yeah, critics point to several key issues. For one, it doesn't account for all the money companies make overseas. It completely ignores the huge impact of interest rates. It doesn't include private companies, and it doesn't really factor in shifts in corporate profitability over time. But the biggest knock against it by far is globalization. The formula compares the value of US companies to only US economic output. But as we all know, today's biggest companies are absolute global giants. And this shows the distortion perfectly. Just take a company like Nvidia. Its massive stock price boosts the US market cap into the stratosphere, but a staggering 80% of its revenue comes from outside the US. That money isn't captured in US GDP, so you can see how this naturally inflates the ratio. And then you've got interest rates. For decades, falling rates have made stocks look way more attractive compared to something safe like bonds. That pushes investors to pay higher and higher prices for stocks, which could mean that a higher than average reading on the indicator is, well, maybe justified in today's world. Okay, so we've got a powerful track record on one side and some very real modern-day flaws on the other. Where does that leave us? What do these signals actually mean for us today? Well, the Buffett indicator isn't screaming into the void all by itself. Other trusted valuation metrics are also flashing bright red. The Shiller-Cape ratio, it's more than double its long-term average. The standard P/E ratio is also way up there. Basically, all these different tools are telling a very similar story of extreme valuation. And maybe the most telling signal of all comes from Buffett himself. His company, Berkshire Hathaway, is currently sitting on a record cash pile of over $381 billion.
That is a loud and clear sign that even he is finding very few things to buy at prices he considers attractive. So ultimately, what's the big takeaway here? It's this. The Buffett Indicator isn't meant to be a crystal ball that predicts a crash tomorrow or next week. Markets can stay overvalued for a really, really long time. Instead, think of it as a powerful tool for setting your long-term expectations. It's telling us that from these levels, the probability of getting low or even negative returns over the next decade is historically very, very high. And that leaves us with the $1,000,000 or maybe $1,000,000,000,000 question that investors ask at every single market peak. With these amazing transformational technologies like AI driving the market, could the old rules of valuation be broken for good? Is it possible that this time it truly is different? History would suggest we should be skeptical, but only time will tell.